Yeah, there's pool envy. Yes.
All right. Good afternoon, everyone. This is Rich Swerbinsky with the Mortgage Collaborative here once again with the rundown with Rob and Rich, our week-ending wrap-up of all the latest happenings in the mortgage industry. And each week we are joined by, of course, Rob Chrisman. Rob, good to see you as always. And this week, special guest host, head of compliance for Active Comply, Melissa Thomas.
Howdy.
Melissa, thank you for joining us.
Happy to be here.
So we like to fill the co-host slot with partners of TMC that bring a unique product to market, something different, something impactful, something high approval rating with the members. And Active Comply is kind of mortgage specific social media monitoring software that is widely adopted by our network. I think we have 40 plus members using it, including 10, I heard, that just in the last few months here in 2021 that have joined on as clients. But I know you guys are doing a lot also in the policy development space, internal workflow process space, both areas of great interest to mortgage lenders right now. Before we get into it, Melissa, tell us a little bit about Active Comply.
Yeah, we've had a great level of success here at TMC, and everyone's been so welcoming. Both the staff at TMC, but the lender members have been great and really vocal about what they need from a provider, from a partner. So Active Comply is a social media compliance software. So we're out there finding social media, pulling it into one universal platform for review, and then we're archiving that content so that lenders can meet those state regulatory requirements for retention. And so we definitely bring software to the forefront. We bring automation to the forefront. I know that's big for a lot of lenders in the mortgage space. For all their departments, compliance shouldn't be snubbed in that regard, right? So we bring automation to the forefront, but then we take it a step further, and we know that sometimes this is kind of a niche part of compliance. So we bring that acumen to the forefront as well. So we're taking a look at, what does your policy look like? How can we modify it? What are your lender peers doing to get LO buy-in? How do you overcome pitfalls? Things like that. So we work on policy development and also internal workflow process. How do you achieve compliance? We want to help you with that burden.
It is, sorry about the barking. My dogs are insane. So
You'll hear mine soon enough, I'm sure.
But as somebody that managed loan originators, I like, the couple of years before I took this job, I remember, starting to monitor what our loan originators were doing in the social media space and being horrified at the violations I was finding, being on LinkedIn and like quoting rate without APR and, quoting we have the best rates in the universe and other things that you evidently can't say. So especially now with the regulatory climate changing once again, space that is important and needs to be monitored. And again, it's always interesting to see, I think we have several partners within TMC that are third-party providers, and it's interesting to see the ones that kind of take off. And it's always lenders talking to each other about the vendors and about the space. And it's really been cool to see you guys kind of take off within the TMC network. So
yeah, and we've gained so much insight because so much of what Active Comply is based off of lender partner feedback. Hey, could you make it do this? How can we make this run better, more automation to this type of workflow process? How do we look for when they mention a percentage rate without APR? Things like that, right? So it's been a really great opportunity here for us at Active Comply. And the system is greatly improved thanks to the lender members, specifically at TMC.
Very cool. Very cool. Thanks again. And looking forward to hopefully you classing up the conversation with Rob and I this week. And so
let's try to keep up.
As Rob overlooks the Vegas Strip at the Broker SinFest conference, and I'm in a t-shirt. So let's get right into it, Rob. How can we not start with the talk of the industry this week? FHFA, in a stark reversal from the collaborative days, just foot on the gas pedal, coming out and with a proposal that they have put out there for industry comment for the next 60 days to pretty significantly, in my view, expand the goals for agency loan purchases on low income borrowers, minority census tracts, and it's significant. I think they only increased the percentages between like 1% and 6%, the goals, but these are goals I don't think have been hit these last couple of years. It is a big, and also announced more strict enforcement measures as well in tandem with HUD. So a bunch of different ways to look at this. I've had a bunch of different conversations this week with our members about this. There's a bunch of different angles. There's the let's do what's right and level the playing field and put more people in the houses angle, which is certainly significant. There's the this is great for business, we can make more loans angle to it. And then there's the hey, I've seen this movie before, it ends badly. Both the Clinton and the Bush administrations made raising the percentage of home ownership priorities of their administrations in different ways. History has shown in the mortgage industry, if home ownership goes above, I think 71, 72%, bad things happen. I'm not saying we're going there, but I always like to throw like the 9-part, 3-minute question at you to open the show. So go at it.
Rich, you took all my answers, but I will answer that in a second, but I think that it bears repeating what Active Comply does. And if I could, because this is all about me, Rich, right? It's always all about me. I remember when I was starting out writing my commentary and sending it to a couple hundred people, and I occupied this space, this niche, however you pronounce it in Ohio, about sending out this commentary that nobody else kind of did, and my business took off. And it really wasn't a business, it was something I enjoyed doing, and I didn't have any real competitors. There were Wall Street firms sending out research if you were a client of that Wall Street firm, or investors sending out information if you were a client of that investor. But I was really just kind of doing my thing, and I didn't have any competitors, and I like what I'm doing now very much so. So when I look at Active Comply, and I've been on calls before with Melissa and some others from Active Comply, and I've looked at the material. It's interesting because, and Melissa, you don't have to agree or disagree, but as best I can tell, you don't have any competitors. So your growth and your business isn't at the expense of somebody else. In fact, you supply this monitoring of social media for brokers, for big brokers, little brokers, big lenders, small lenders, credit unions, whoever, who have a sales force. And salespeople are like, oh, we got the greatest rates in town, or we got the lowest, we take the lowest FICOs and so forth. And your company monitors that automatically. So you could have Wells Fargo or Citi or whoever with 10,000 loan officers, and your company monitors to see if Rob Chrisman out there is talking about what great rates we have, and that's a no-no. And so you automatically bring that to management's attention. So I think that bears repeating, which I just did. I mean, do you agree, disagree? What are your thoughts on that?
That's so kind of you. I mean, I know that you've seen the software, and your cats have seen the software specifically. We're so happy to hear you say that. We do have some competitors. The trick of it all is that they do a whole bunch of different industries. They do the medical industry, they do hospitality. And so it's a tool that you really have to build out. They don't know the nuances of our highly regulated industry. And it's, if you have a problem with your heart, you need surgery, you don't see a podiatrist, you see a heart surgeon, right? So we try to make things really specific to this industry. We've tried to build it out to do one thing and one thing really well, and that's mortgage industry compliance. And so we've made that our goal. And yeah, to your point, we're really scalable. I'm so glad that I don't have to do this manually for our lender partners, and that automation is at the forefront, because it would be an undertaking for sure. For depositories, for credit unions, we serve all the like for sure. So thank you for that double shout out.
Sure, you bet. So Rich, to answer your question, I have received a different thinking on the FHFA and housing affordability and affordable housing goals, et cetera, et cetera. And we kind of knew this was coming because of the Biden administration versus the Trump administration, so it's understandable. On a big scale, I think it's important for people on the call to remember that when FHA or VA or Fannie Mae or Freddie Mac or the FHFA or bond programs make a change to their pricing, to their underwriting guidelines, to their programs or whatever, it has a ripple effect through the industry. And so if the FHFA decides to go down some path, that has ramifications for the percent of business that's going toward FHA or VA. None of those groups, none of these big groups want to be known as kind of the lender of last resort. And so nobody wants to be in a line with FHA and VA and everybody and have everybody take a step back and you be still standing there. You stand out, and so you get adversely selected to. So I'm hearing chatter about that with regard to, okay, what impact does this move have on other agencies like FHA business? But on a micro level, and more to Melissa's concern, is you have a lot of originators out there who are looking at these changes. And in fact, in my opening paragraph tomorrow, Saturday, I have a letter from an originator, from a broker who happens to be both in New Jersey and in Florida. And the broker said, you know, what this is all well and good, but what tends to happen is in low loan amount areas or high loan amount areas, but who have affordable housing where the loan amounts are, you know, $200,000, $250,000. When you get into that size loan amounts, you can run into issues with regard to QM or LO comp and some of the requirements of pricing. You know, you don't want to obviously be accused of usury, but with regard to a maximum of 3%, blah, 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 when you have low loan amounts that you oftentimes see in affordable housing, it's sometimes difficult. And so it'll be interesting to see how the actual loan officers and how companies deal with this when, you know, if they see a lot of $100,000 or $150,000 loans coming through. First of all, originators tend to, I won't say shy away from doing those loans, but if you've got a $600,000 loan and you're going to make 1.5 on, or if you've got a $100,000 loan and you're going to make 1.5 on that, the tendency is to move toward that $600,000 loan. So I'm not saying that originators ignore low loan amounts, but when you talk about affordable housing and some of the things the FHFA is proposing, you start to get into those low loan amounts. So I'm just saying it'll be interesting to see how the industry and individual loan officers deal with that. So that's what I'm hearing.
Listen knows, or somebody in the audience knows, but to your point, the high cost loan laws, like I remember, you know, when I was running lending for a bank 6 or 7 years ago, there was like, if we were doing a $30,000 loan in the city of Cleveland, you can only charge like a maximum of like, I don't know, 2.5 or 3 points at the time in fees. So that was less than, you know, if our regular loan, non-third party lender fees were $1,000 on a loan, you know, we can only charge $800 or whatever it was. And, you know, if a loan was even lower than that, I mean, so there were loans we lost money on that we did, and we did it because we wanted to do the right thing, but we would legitimately lose money as a company. I don't know, Melissa or the audience, at the high cost loan laws, anybody know the current state of that for these low loan amounts?
I don't right offhand. I do know that the way fees operate can sometimes vary greatly state by state, and that it will be very interesting how those different markets handle this paradigm shift. And it'll be kind of difficult to track that for some time. So it'll be good data to see when it does come out.
We got some comments coming in the chat. One, my fellow Browns fan, Dave Conway in Virginia, saying "Go Browns." We have a nice plug for Active Comply, saying that I'm currently logged in as my team, and I monitor our social media websites for compliance. It's a well-built platform that is getting better. We love it. On the current issue, cost of doing business. And then another comment, sometimes you cannot do them due to high HPML unless you have a portfolio product. So for banks and credit unions, you could do them in the portfolio. It's some kind of special product. But another tentacle to this is, so if I'm understanding this right, they're increasing the goals. There's no way humanly possible to get to these goals without a couple things happening. One, forget about the PSPA amendments. Like they have to be, there's no way that the non-owner limit probably goes away or has to. And the things that are in there that were to be implemented have to go away. I've heard, I think it was in your column, Rob, that getting the PSPA amendment amended is a long process that is not easy, that has to go through Congress. But in addition to that, they're going to have to expand the credit box. Absolutely, right? They're going to have to create some new programs and loosen guidelines like they did First Domino with the rental payment history being allowed to be used. Have you heard anything from the Charisma Nation on that?
Yeah, I think I may have made the point in the last week or two, Rich. If let's say I go to Melissa for a loan because Melissa's offering money at 0% and she doesn't care about my credit. She doesn't care about the collateral. She doesn't care. She's just saying, hey, Rob, my great aunt left me, a couple $1 million and I just want to put it to work for unfortunate people like you. And so suddenly I have this offer of free money at 0%, and she's not going to underwrite my loan. She doesn't care about my credit and my overdue payments. Well, but if I can't go out there, if there's no inventory, it doesn't matter. I can't even find a house to borrow the money at 0%. So you can stretch the credit box, expand the credit box as much as you like. And it may not make any difference if the inventory isn't there. Now I'm hearing anecdotal stories about inventory coming on the market because at some point, they're going to sell. But to your point earlier, Rich, about the, just the the goal of having a home ownership percentage, like, oh, this is the United States and we should have home ownership of 70%. I think that's a big mistake. I think, we've seen that movie before to go for that. Every originator on this call will tell you that not everybody wants to own a home or deserves to own a home, frankly. And so when you start, dangling things like, easy credit or FICO's down to 300, personally, I think you're asking for trouble. So,
Melissa,
my 2 cents.
the compliance tentacles to this, like from your end of the world, I guess all this Fannie Freddie stuff, first they were tightening, then they were loosening. Obviously it impacts salespeople and messaging on social media. Just what have you been hearing on this issue and anything specifically this week related to some of these purported changes?
Sure. So I think it's noteworthy, August 11th, they were talking about the announcement of, hey, rental backings, being a part of the credit reporting. And my first thought process was, oh, that's so great for the younger generation. And it may not have any impact, for some time, but it's going to help them build that credit. It's going to make a difference. And to that point, we also saw increases in social media activity about that announcement, being shared out by loan officers where they had commentary along the lines of, you didn't think you could do it before, but now you can. Go ahead and start doing this now and set yourself up for success later. To that point, it's so new to all of us, this new inclusion of rental history when it comes to credit reporting. So I would proceed with caution from a compliance standpoint. I definitely wouldn't make any promises about how that could impact the credit or what that would look like, years from now, or how they should come in now to see their loan officer when it's just been enacted. So there's some deceptive practices that could be putting into play here with that announcement, where they're saying, oh, now is the time, when maybe that may not show up on the credit reporting, for years later. It may not have any impact.
Interesting. So transitioning topics, something I'm also interested to get both your opinions on, the damn Delta variant. I'm so sick of talking about the goddamn pandemic, but it is not going away and continues to, wreak havoc in different ways. It's impacted our industry greatly. Biggest year in the history of mortgage lending ever last year. MBA's latest projections, they just came out with, I think, are for 3.7 trillion in originations this year. I personally think it's going to be much higher than that, maybe higher than last year. But you're looking at maybe the 2 biggest years in the history of mortgage lending back to back. Everybody moved to home, work from home, rates have been low.
Mhm.
Travel, this is a big travel industry. That's been curbed on some level. Just what we're seeing on social media. Part of it's a byproduct we're growing, and Gabriella and our team does a good job, I think, on social media. But I feel like this work from home thing has just the eyeballs on social media in general have gone up big time because there's more people from home. There's not people walking past
Yeah.
cubicles. Is that what you've seen?
I think it's really noteworthy that, the Freddie Mac data that was released on the 22nd of July talked about how there's anticipation that rates are going to stay low. We're going to have another year, thanks to the Delta variant, of continued housing market booms. And to Rob's point, I think that on some commentary not that long ago, you had said in your top slot about how there's currently more realtors than houses on the market, right? There's more licensed people than houses to sell, which I always love to reference at dinner parties now. So to that point, it's very interesting to see people vie on social media when it comes to, hey, here's this advertisement for this home that just went up. And then LO's getting in those comments talking about, let's meet up and talk about the financing that's available to you, the best loan product that might be available for you as a person. And then there's LOs that take it that wrong direction, where they're just sharing the listings back and forth. And there's this concern about RESPA Section 8. So how often are loan officers just sharing their favorite realtor buddies' social media post about a listing? And is there some kickbacks occurring around RESPA Section 8? Do you only promote one particular realtor partner? And things are happening so fast that they're really racking up back to back to back postings around that. So some of the best practices that we've seen a lot of recommendations for is that instead of just sharing the posting for the particular house that's going up and then it's going down very quickly, right? Instead, it's to say, let's talk about what I can offer you. Don't make any promises, but make it all about how you can promote your services. It's not just about the free advertising that you're giving that realtor partner, and also sharing the love. Make sure that you're not promoting one particular realtor partner or builder partner over and over again. Definitely taking that time to diversify your own referral network.
Interesting. Bunch of good comments in the chat. One from Cindy Leonard. Minimum compensation helps to encourage folks to do the right thing. It's on lower loan amount loans. If you're paying 80 basis points to all your LOs on every loan on a $30,000 loan, it's $240. I think we did it was like $600 minimum commission on any loan. So we'd encourage our loan originators to make lower loan amount loans. But again, it goes to the whole losing money when you can only charge so much in fees and you have a minimum LO comp, unless you're putting in the portfolio and not selling it, which, a lot of independent mortgage banks don't have the luxury to do. Put you in a situation as a lender where you're losing money on low loan amount loans if you have to sell it. Comments about social media in general, some other minimum comp comments coming in. A question for you, Rob, about taper tantrum. What's your current? It feels like the taper momentum is building, right?
So I need to address a couple earlier topics. So Rich, you mentioned like a $600 minimum compensation per loan or whatever it was. And I think that kind of income allowed you to create that finely tailored wardrobe that you often sport
exactly right.
on this show. With regard to the pandemic, yeah, I'm tired of talking about it too, but we were reminded of that today. I received an email from the NBA saying that they will require vaccinations if you want to go to attend the NBA event in San Diego in October. So proof of vaccines, and I don't know what that proof means because I hear, I've got a vaccine card I carry around in my backpack, but I know there are a lot of counterfeit vax cards out there, and so that'll be interesting monitoring that. It's really too bad, to your point, that it's coming to that, to have to show some kind of, your papers, please, before you go to a conference or the restaurant or whatever. It's not a good situation. The taper tantrum, I think I'm gonna grouse about that. I'm gonna put on my curmudgeon hat, which I'm good at putting on. But frankly, throughout most of the history of the Federal Reserve, they weren't out there buying billions of dollars of Treasury and MBS assets every day. And it's not their natural it's not their goal. I mean, it's not their role in life necessarily to add to their balance sheet to the tune of $5 billion of MBS every day. So yeah, we had a taper tantrum. I think it was back in 2013 with Ben Bernanke. But the fact of the matter is, the Fed can scale that back over time. And yes, it will have an impact on rates. And we can all expect that the Fed will stop buying securities eventually, or they'll taper off and then they'll stop buying them. We can all expect that. And I think some of the knee-jerk reaction that the markets have to news like that, it's like they don't have anything better to talk about. So let's talk about something that may not happen until 2022, and let's move interest rates now for something that may not happen for 6 months or a year out that we all expect to happen. I think is a little bit ridiculous. And frankly, when you talk to the average loan officer, successful loan officer, and Melissa probably deals with this a lot more than I do, but the typical successful loan officer who is probably successful when rates are much higher, the taper, not taper, Fed, no Fed, whatever, they're going to continue originating loans and they're going to stick to their business plan. And some of this that goes on out there is just noise. Interest rates impact their business, but conjecture about what might happen 6 months or a year from now doesn't have a lot of impact on the typical originator's day-to-day business. And as we all learn, I'm really on my soapbox here, Rich. As we all learned, at the beginning of 2020, when all these experts were out there making predictions and talking about volume and talking about rates and so forth, we were reminded once again that predictions are worth aren't even worth the piece of paper they're written on, because everything went to hell in a handbasket in mid-March of 2020. And who saw that coming, really? So for the market to react to something that we know is going to happen eventually anyway, we don't know when, we don't know by what, but it's going to happen. But for the market to jump around about tapering off, I think is not a great play. Put it that way.
That's so true, Rob. The people making those projections are like weathermen, where they get paid anyway if it turns out to rain the next day when they told you it was going to be sunny. And I agree. I don't think that the projections have as much impact on the successful loan officers or their book of business. I agree.
This is the Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Krisman, and this week Melissa Thomas, the head of compliance for Active Comply. Changing topics, just been fascinating to me. And I think this is a byproduct of just the polarization of government and politics in general. You look back at just housing policies, going back to Clinton and Bush. Obama started to move more to the edges, but those administrations governed much more in the middle. And, I think you've seen the last 2 or 3 presidential administrations governing much more on the edges and to the base. It's bled into our industry. And it's just been fascinating to me, the credit and regulation pendulum. Like you had Trump, which in his administration, it was like scale back regulation as much as humanly possible, but yet we're going to try to just close the Fannie Freddie credit box. Biden administration comes in and they are ramping up the regulatory side of things, clearly, yet they're expanding the credit box. So it's like, things that are almost counter to one another. I've been saying it for years, like the best place to be in almost everything in life is closer to the middle and not on the extremes. But really with our industry and the credit regulation pendulum, we've really been on the extremes. Melissa, from your perspective as the head of a compliance organization, you mentioned RESPA and TILA concerns. Like there was no mention of that. My last job, I remember my last year at the bank I worked for before I took this job, I spent a large part of it unwinding all of our marketing services agreements with RE/MAX and Keller Williams offices, because we were terrified of the enforcement actions that were coming down. The gray RESPA interpretation, being accused of RESPA violations for referrals of loans. Then those concerns completely went away. And now lenders are starting to get a little bit more terrified about it. Talk about that climate from your perspective right now.
Yeah, definitely a pendulum. And I do want to say, first of all, I work for a compliance software company, and so business has been good. But I do feel for my compliance counterparts that are at mortgage lenders right now who are having to do the work of those examinations. We've seen a big increase thanks to the change of administration, specifically around fair lending. So that's the big topic of discussion for most regulators. We're seeing a lot of fair lending specific audits in New York, Virginia, California, some of those heavy hitters that we normally see. And they're going a step further than they used to. So it's no longer black and white. Is this a clear violation of fair lending, things of that nature? But is there some sort of subliminal messaging happening? So you're on social media, you're posting, talking about different loan products, you've got this great social media presence, and that's awesome. But for the past 7 posts, what family, was it a quintessential family of one specific demographic? How does that portray to other consumers who might want a loan product with you? How does that leave them feeling at the end of the day? So things are now becoming a lot more gray, to your point, where it's not just, is it a thought experiment? But really it's what is your marketing department doing? Let's take a step back and put on that fair lending lens when it comes to making our marketing materials. What does that look like? Do we have equal housing information in all the right places? Are we making the right decisions when it comes to loan pricing and things of that nature? So definitely the first step is advertising what's front and foremost for all those regulators. They don't even have to ask you for social media. They go out and they find it before they even get to you. And generally when there's going to be a social media audit, they already have the findings before they've even told you that there's an exam coming. So we've definitely helped a lot of our lender partners through that. I know that New York was very particular about targeted ads on social media. So Facebook in particular gives you the opportunity to pick and choose who sees your ad. That means you get to pick certain zip codes. Well, then we have a redlining issue, or specific demographic information, which goes right against fair lending with those protected classes. So one point of contention is definitely targeted ads. How do you find the middle ground? As you said, middle is best for most things. With your loan officers, how do you be compliant, but also make use of this really great tool? And what guide rails are you putting in place from a policy perspective around social media marketing, period, but also that targeted ad base?
Rob, was it this way during like the Kennedy and the Taft administration? It seems like things are so polarized. I mean, with your vast experience in the industry, your perspective on these last couple of presidential administrations.
So Melissa, you need to know something about Rich. He's misguided sometimes. I was not alive during the Truman administration or Taft administration.
We got Van Buren. What about Van Buren and Chad?
Van Buren administration. I wasn't in the Trail of Tears from Andrew Jackson.
Do I got to get out of here? Is this between you guys? Do I need
anyway? It's tough because everything else, just as we've seen this change in administration, it's the rallying cry, and I won't go too far down the political path here, but one of the rallying cries for the Biden administration was, return to normalcy. Let's bring the pendulum back. And it's not only the pendulum with regard to mortgage regulations, which I'll get to here in a second, but with so many things that are going on around us, the Trump administration pushed the boundaries for many things, whether it was regulations or oil drilling or foreign relations, whatever it might be. And now I'd say the Biden administration is coming back to, like it or not, coming back to more of the historical norms. But you're right, the regulatory environment is very, very subject to these swings, and it's tough if you are running a company or you are a loan officer having to deal with changes, Rich, that you mentioned. And when I talk to originators, and I've talked to a few here, they say, all we want to do is do our job. We're just trying to help our borrowers, and to be subject to the direction of the wind, as it were, with regard to regulatory environment. It's tough for them, and so they tend to rely very much so on their compliance departments more than ever, or on outsourcing, like to a company like Active Comply, where that's all they do, and they the compliance folks, these mortgage companies, they are dealing with a body of work, and they are not their job is not to predict necessarily where the compliance environment is going or what's coming down the pipe in terms of, rules and regulations or what the CFPB might do, but they're aware of it. So for example, the CFPB has made it clear that they are looking at servicers in this COVID environment and not, shutting every borrower out in the cold. The CFPB has made it clear. So the compliance folks that I've talked to are aware of that, but they aren't trying to predict necessarily the nitty gritty of what might come at them. They are dealing with what they have to work with now. And you're right, it's changing. And so they're trying to deal with the change. And it can be tough for a compliance department. And it can be tough for loan officers who are very cognizant of changes in compliance and they're trying to do the right thing. And it's sometimes it's tough to keep track of. But I think the Biden administration has done a pretty good job of saying, okay, this is where we're heading. And the CFPB has done a pretty good job of talking about where it is heading as well. So, but like I say, the compliance folks they can't predict the future, but they can take what they have now and apply it to lenders everywhere.
And that goes in turn that, with the topic of fair lending, it's inevitably going to be blended really well with brand reputation, especially on social media. So we're seeing all kinds of items around fair lending that inevitably evolve from one social media post that maybe an HR director at one particular mortgage lender had feelings about a specific demographic, which views were her own, but that reflected poorly on the institution, of course. And then it became all kinds of problematic in different ways where angry consumers, it went viral. And so they went and had all kinds of negative reviews on social media. There was a huge stream of negative reviews for that mortgage lender, not to mention that person being in the HR role. She had previously let go people of that demographic. So then there was wrongful termination suits that went on for years, very expensive and costly items. And then brand reputation, how do you measure that? So social media, fair lending, brand reputation, all intertwined for sure. And being aware of those types of items, who was on the January 6th Capitol riot? Is that one of your LOs that's going to be on the front page? How do you look for that on social media? Things like that. So I think that brand reputation intertwines with fair lending, and therefore marketing and compliance are intertwined, all with the same goal of wanting to create value within the business, all while keeping the licensure, right?
This is the Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined by Rob Chrisman and Melissa Thomas of Active Comply this week. And Melissa, to that point, we added a session at our upcoming conference just outside Los Angeles coming up in a month. It's something titled along the lines of preventing a social media disaster, because as we did our collab labs in the spring, we heard multiple lender members talk about exactly what you just talked about, where some random loan processor or loan originator made a post on social media that may or may not have been viewed as offensive by me or you or Rob, but was to people, and the lender member either did or did not take action against that individual, which created a lot of divisiveness within the company. And obviously outside commenters and observers. So and it's something that could be really cancerous to an organization and something that's important to keep an eye on. And another thing you mentioned that was interesting to me, because I've heard this from our members as well, is Facebook advertising. If you're a lender right now and you are only doing Facebook ads in like the white ritzy suburbs, that is a problem right now. And it will be absolutely a problem if you undergo a fair lending audit. I went through fair lending audits annually for many years. On the flip side, I've heard a lot of our members saying they're going to start using Facebook advertising the other way, to start targeting communities where they're not doing enough lending, where there is more diversity, where there is more low to moderate and affordable lending opportunities. So I think Facebook advertising in general is going to be something that mortgage lenders are going to be talking about a lot more, because you can use it very, very targeted.
Yeah, and this kind of all was a lead up into my shameless plug that Active Comply is going to be co-hosting that session with social coaches Joe Wilson to talk about how to prevent a viral social media disaster at the summer conference in sunny California. We all get out there in September. We'll be leading that discussion with something that we have here at Active Comply titled the Wall of Shame folder. So we have some really exciting, blurred out items that we're happy to share of real postings that could have been disastrous had the lender not caught it. So keeping with that in mind, targeted ads and where stories are, those disposable media items and things like that. There's a lot of nuances to social media and how you can use it for your benefit, but there's a lot of pitfalls too that are worth discussing. And I think I saw somebody earlier say something along the lines of in the chat, why do social media at all, or why would you allow it? In which case, I, as a compliance person, I'm like, yeah. But unfortunately, social media isn't going anywhere, and your loan officers are already using it. It is a really great tool if you can use it right. So how do you put those guide rails in place? How do you sleep good at night, knowing that you have protection? Automation being the forefront of that goal.
Got a couple minutes left, a bunch of stuff in the chat. Just want to get your guys' reaction to the earnings of mortgage companies, just disastrous in the second quarter. Every mortgage company known to man that's out there publicly is tanking. Matt Ishbia, once again, making headlines, blockchain payments. The numbers on mortgage brokers are going down. There's concrete stats on the percentage of loans being originated by brokers. It's gone up these last couple of years. It's going back down. And he completely refuted those comments, saying he's got his own research that's saying it's going up and they're going to be a third of the industry. Rob, any comments on your buddy Ishbia or public mortgage companies? I always try to get you in trouble, at least once.
Within 30 seconds, in the next 30 seconds. So I on my smartphone here, my smart flip phone, I have a stock ticker or whatever. I can watch different stocks, and the fact of the matter is the stocks have done nothing but that kind of thing, unfortunately. And it goes back to what I would write about when these companies went public, and the reason for them to go public wasn't necessarily the basic issue was when they went public was to help typically the venture capital fund or the private equity fund or whoever had the lion's share of ownership. It allowed them to sell at the high of the market. And I made that comment a number of times. And sure enough, the venture capital folks are not in business for their health. They're going to take a profit when they can. And the market, I think, has borne that out. When you look at the dividend yields, and some of these companies like United Wholesale, they do pay a dividend, and the dividend, as the price goes down, the dividend percentage goes up, and at some point it becomes unsustainable. And it is viewed generally that they will cut their dividends, those companies that pay a dividend. If the only company I think that might be higher than their IPO price might be Guild Mortgage. But yeah, the Loan Depots and the Home Points and Rockets and so forth, they're not having a good time of it, for a lot of the reasons that the people on this call and in our industry realize. Even if rates were to stay here for the next 10 years, you get refi burnout, you have competitive pressures, you have margin pressures. Yeah, the list goes on and on and on. So Matt, I would be hard. I'm not gonna contradict anything that Matt said or will say. He's got a lot more attorneys on his staff than I do, so I don't think that he would say anything blatantly false, especially now that he's in a public company. But yeah, I would say it's going to be tough time for publicly owned lenders ahead,
especially only in one channel that's the lowest profit margin channel and the most competitive. But I'll leave the real analysis to the financial experts. So Melissa, any parting thoughts? Active Comply, such a great partner to TMC. Anybody wants to talk? We have like 40 some members that are very happy clients. That's the way we try to connect members with, hey, I'm thinking about this, I'm thinking about that, I'm thinking about, well, talk to a current client. that's how you've really grown. Any parting thoughts, any exciting weekend plans? What's going on in your world this weekend?
I would encourage anybody, I mean, even if you have a solution in place of some sort, if you're manually monitoring, something you can do is reach out to Active Comply. We provide free compliance reports, so you can get a sample of some of the findings. At least you'll be able to take care of those heavy hitters. Maybe we see some things that you missed, or we know some policy items that are really noteworthy for regulators right now. We're happy to provide that assistance. We also are happy to answer any questions you might have about the niche compliance world of social media compliance. Happy to do so. This upcoming weekend, I just moved to Portland, Oregon, so I'm going to go see Mount Hood and do some hiking in a lavender field. So I'm pretty excited for this weekend.
We've talked about on this show. I've never been to Portland. It is literally the #1 city I've never been to that I would love. I've heard it's a great beer town. I've heard the people are cool. It's a really chill city with a lot of good outdoorsy stuff. You just moved to Portland from where?
I just moved from Orlando, Florida. So a big old diagonal away from the equator. I was told to, when you get off the plane, you get some riot gear as soon as you get here. That didn't end up happening, which is very interesting. I guess Amazon is going to come in handy at some point. But yeah, it's been a great move, and Active Comply has been a great company to work for during this move.
Nice. Rob, you've been everywhere. How would you rank? How would you rank Portland? I've heard it's a great beer city. I love beer.
I don't even know where to start. Melissa, I will introduce you to some pals up there.
Awesome.
Who will, I'll do that via email. Rich, you're not going to ask me about my plans this weekend. My plans this weekend are, I'm not going to gamble here in Las Vegas. I'm going to fly home this evening, and then spend Saturday doing some exercise. And then Sunday, I fly back to Las Vegas and then drive across Southern California with a couple pals to the Western Secondary on Sunday afternoon. So I am Western Secondary bound on Sunday.
You're not a lot of cat markets guys and gals are gamblers. That's my upbringing. I am a degenerate gambler. So, maybe I'm just speaking about myself, but I've made that observation. You're not a gambler?
No, I just sometime over a beer or a glass of wine, I'll tell you my gambling story. But I gambled with people's pipelines every day. I didn't need to do that on my downtime.
I think that's how I got down there. I'm gambling with so much of the bank's money every day. I might as well do it with my own.
Completely opposite perspectives on
right
here, everybody.
Right. So, well, Melissa, thank you again for joining us. Really enjoyed having you as part of the conversation, and enjoy and appreciate all that you and Active Comply do for our members, and looking forward to seeing you in Terranea. And Rob, as always, great to see you. Look forward to seeing you in Terranea as well. We're doing the rundown live during lunch on Tuesday. We are all systems go. We've had some questions from people. Onward ho with TMC Summer. We've got record attendance. We've had 2 people deregister. Is that the right word? I don't even know. But so, we're looking at a huge audience and a great venue, and a big family reunion. So, but Melissa, thank you.
Thank you. And shout out to everyone who's giving me food recommendations in the comments. I appreciate you as well.
And Rob, as always, thank you. We're now weekly with the rundown. So like it or not, every 3 p.m. Eastern on Friday, we'll be back, and we'll see you at this time next week. But Rob, thank you again.
Very welcome. Thanks for having me.
So good to see you both. Glad we could be here together.
Too.
All right. Take care, everyone. Have a great weekend wherever you are. And we'll see you next Friday at 3 p.m. Eastern with the rundown with Rob and Rich. Have a great weekend, and next week, everybody. Take care.